The Fiscal Fortress, where wealth meets wisdom.
Hello, Eric. It's good to see you again for another episode of Fiscal Fortress.
Yeah, it's a real pleasure. I was looking forward to this, and I know that you're in Hawaii for vacation, so I'm very grateful that you were able to take an hour out of your vacation to shoot this video.
Well, it's there's a lot going on in the markets, and we don't want to delay our audience for another 2 weeks. I guess right now, top of mind, what's on the news is certainly the continuation of the stock markets and how it's just extremely volatile.
Extremely volatile. We're recording this on a Monday, and unfortunately, there's been more bad news in the markets. So the last few weeks, all the news was about the trade war, the global trade war. There's a lot of back and forth. Originally, it was a trade war that affected literally every country, maybe with the exception of Russia, I heard. But so might have to fact check me on that. But almost every country. And then the administration shifted gears. They actually paused those, increased tariffs globally, with the exception of there's a 10% tariff that was a baseline tariff, but they had additional tariffs that were paused. Everybody jumped for joy. They were very, very happy, except they did not exempt China. And in fact, they ratcheted up the tariffs on China, and there was a back and forth. I think today we're imposing 145% tariffs on China. They're imposing 100+% tariffs on the United States. So it's a really bad situation. The markets then became very sober and realized that we're not out of the woods, that the global trade war with China is not a good thing. And so the market started declining again, and then declined again most recently because the president has talked about potentially firing Jerome Powell, who is the chairman of the Federal Reserve. They're an independent government agency. The president theoretically is not supposed to have that power. And that has created a lot of concern by people in the stock market as well. So a lot going on.
And then there's also the fact that the Pope has also passed away, and that has sent as if there wasn't already enough political instability to have all that uncertainty, not knowing who's going to take over now too.
Yeah, absolutely. It's a really, sad day that the Pope has passed away, and I know, millions of people are extremely distraught by that.
A lot going on in the markets, and then of course, markets are in just unpredictable territory at this point. If any of our listeners wants to have more information about anything we're saying in this episode, feel free to reach out to Eric directly. He'll be glad to answer any questions. And then for my clients who have questions about their estate planning during this period of uncertainty and want to hang on to capital preservation, then in their documents, then please also feel free to reach out to me as well.
Yeah, just to add on to that, a shameless plug about the Lighthaven Fund, which is the hedge fund that I run. Despite the market being way down, depending on which index you track, down 10 to 15% year to date so far. We're only in April. The Lighthaven is actually up. We fully hedged out the risk of these exogenous events, these world events. And if this is something that you want to potentially diversify into, would love to talk to you.
And then the difference is even more profound, right? In the sense that for many stock indices who have actually dropped, and for you to be ahead means that that spread is just incredible, like probably over 10-20% difference.
Yeah, I mean, we're handily outperforming the market this year, and we did that again last year. It doesn't happen every year, just to be clear. We're not, tracking the market perfectly, which is actually one of the reasons that a lot of clients like to diversify into alternative assets, such as hedge funds. But this is very much a way that you can, protect yourself from risks like the ones we're about to discuss, or we have been discussing these last few weeks.
I guess one of the places where we can start, Eric, is about when people talk about the markets and hear it on the news, shouldn't we be more specific and say whether we're talking about stock markets as opposed to bonds, crypto market, real estate market, gold? Those are all very different measures of the markets.
Yeah, 100%. It's really true. When people talk about the market, I do think that most people are talking about the US stock market because that's, just by the numbers, it is the largest market. It's where the majority of assets are held. That said, or for individuals, that said, there are other important markets. So, um, you mentioned, fixed income, like the US Treasury bond market. There's corporate bond markets. Gold is absolutely top of mind for people. Younger investors are investing in crypto, such as Bitcoin, real estate. That's obviously a market. So there are many, many markets. But I think when we talk about, or when I talk about the market, I am referred specifically to the US stock market.
For our listeners in this episode, there's no point in really talking about too much on the past because it's very clear what's happened. A lot has happened in the last 3-4 months of this year. But in terms of a lot of people are asking, what do we do now? Because at this point, there's some wild swings going on. Should people just withdraw from the market? I mean, it also depends on what age some of our audience is, right? If they're on fixed income, that's probably a really hard time to be entering into the markets. It may not be wise to do so.
Yeah. So first thing is that we're not giving any financial advice on this podcast. You absolutely have to talk to your own financial advisor because, as you alluded to, everybody's situation is different, and I don't know, what each individual situation is. I will say that it is a question of risk tolerance. So if you have a very, very long period of time to recoup losses, let's say, you're not planning to retire for 20, 30, or 40 years, then you're in really good shape, right? Because you have a lot more options. On the other hand, if you are to take something on the other end of the extreme, the spectrum, if you were planning to retire next year, then you're going to probably want to be much more conservative just because you don't have as much time to recover from a mistake or a decline in the stock market. So what I would say is, I guess, two things. You do have to um, stay calm. I think that's the most important thing. And the reason is very simple. It's very, very difficult to make good decisions when you're panicked. And so I think like this, it happens across the stock market that a lot of people just knee-jerk reaction. They're scared and they sell all their stocks. I think that's a mistake. And again, this is not investment advice. This is just general investment wisdom. That's not to say that this is not a good time to sell, but what we should do is we should analyze very rationally and clinically what's happening and accept that you are essentially, whatever decision you're essentially making a bet on the future and you're making a prediction. And there are some assets where if you don't want to make that bet, you can invest in something like that. So I'll give you one example. If you're not interested in making a bet on the future, you could, if you're invested in something that is income producing, like a house that produces, where you've got a renter, or you're invested in a fixed income, like a bond or a dividend stock that's paying you something, and you actually, you're not planning to sell, then that's one category of investment where I think you could, probably sleep at night. The one big caveat, though, is if you do think you need to sell, then again, you're back in the situation where you're making a bet. So I'll give you one example. A lot of people who invested in US Treasuries right now, this is very controversial. They thought, well, that's a safe haven asset. But unfortunately, the price of those bonds had declined. Despite the fact that normally when the stock market declines, people rush to those bonds, US Treasuries, as safe haven assets, and usually they go up or stay level. They've actually gone down. So again, not an issue. If you bought a 10-year US bond and you're not in a hurry to sell and you can hold it all the way to duration, this doesn't affect you. But if you might need the money and you need to sell, now the price movements of that bond really start to matter to you, and it hasn't gone the right way. So that's the one caveat I would say.
So we talked about the stock markets. I know that for gold, for instance, it is at an all-time record high. Do you have any thoughts about that? Should people be buying at this time, or to keep an eye on it?
Yeah, so I mean, I'll be perfectly honest. I don't have a crystal ball, but I can give you some, my personal reactions to gold and also the stock market. Um, I think the stock market. Well, let me start with the stock market, and then I'll turn to gold. The stock market has declined, and it's declined for some very specific reasons. People think that the trade war will cause inflation. They think that the trade war, if there's inflation, interest rates could potentially go up, and that's bad because they'll make it more expensive to borrow. They think that if we isolate China, there's a potential that they might do unpredictable things, whether it's collaborating with the European Union from a trading perspective or Canada, or in the worst case, could this incentivize them to invade Taiwan? So I would say that on the stock market, it's really, I mean, I'll just say that the Light Haven Fund currently is actually a little bit short. So we're normally very long, meaning we're very optimistic. Right now, um, we're fully hedged out. And if the stock market goes down, the fund will actually do pretty well. And that's a reflection of the fact that I think a lot of institutional investors and hedge fund managers don't think we're out of the woods yet. And in fact, they think that things could be worse. A few weeks ago, we talked about the AI bubble, potential bubble, and how the S&P 500, most of that value and most of the profits came from like 7 or 8 companies, the so-called Magnificent Seven, and how they were all AI companies. Well, that has been the case. Like those companies have gotten hit really badly, and people are now seeing that. Uh, we're not sure. I'm not sure that that the damage is done. So what I would say it as, I'd be very cautious about trying to time the bottom here. There could be a decline in stocks, and that is one of the reasons that gold is at all-time highs. Right now, there is a feeling that there's no place to hide. As I mentioned before, government bonds have declined in value. The yields have gone up, which means that the price of those bonds, if you're holding them, has declined. Stocks have declined. Interest rates remain high, and real estate is not doing that well. Real estate tends to do better when interest rates are low. And so there are very few places where you could put your money. Gold is one of them. And very interestingly, so is Bitcoin. So it turns out that, Bitcoin has actually held up a lot better than the stock market. That's not the case of all cryptocurrencies. So Ethereum and these other meme coins have declined. But Bitcoin, which is the quote blue chip crypto, has held up remarkably well,
I
actually.
agree. I think when our listeners are thinking about cryptocurrency, there is definitely a big difference between the quality of Bitcoin and the risk versus some of the ones that can disappear overnight or are just fraudulent altogether. And then in terms of real estate, I've been hearing that prices, because the interest rates are so high, that prices are they're not going up any more than they are. In fact, I heard that somebody bought a house at less than asking price, which for where we live in the Silicon Valley area, it is actually it's very uncommon to have houses sell less than asking price.
Yeah, I remember not that long ago that people were expecting that interest rates would decline. You'll recall that the Federal Reserve, for several years, like 3 years, they've been fighting inflation because inflation was very high right after COVID, and they kept, bumping up the interest rates. And then there was a lot of positive news that, hey, we've almost licked inflation. Inflation at one point was at 8% per year per annum. They got it down to under 3%. well on their way to the 2% target, but they didn't quite get to the 2% target. And then there's this trade war. And now the fear is that, if we are imposing tariffs on Chinese made goods, well, it's all imports, especially Chinese made goods. Wow, that's going to result in, I've seen numbers where like toys for babies and things for babies are going to go up like 30%. Electronics are going to go up. We've all read about cars. People are rushing to buy cars before the tariffs kick in because cars will be $10,000 or $20,000 more expensive.
And then even just grocery stores, I've heard of how people are stockpiling, which is very, it reminds me of the pandemic when people used to do that. They just want to get these goods that they know are going to go up. But how much can a person amass personally, right? Unless we have a store or something, how much can a person buy? So there is a lot of fear-driven activity. And I think that it really is a reflection of just that people are it. This is not a time to be bullish.
Yeah. And the one thing I'll say, look, and I've been honest, like I'm concerned about the stock market. The Lighthaven Fund is slightly net short, which means we will actually do well if the market goes down. Um, but I will say this, like and I don't believe you should time the market. I don't believe that. But I do believe that in times of crisis like this, when the stock market is really beat up, for the people who are long-term investors, if you do have that 20, 30, or even 10-year, 20-year time horizon, I absolutely think you should start coming up with your shopping list. There are going to be, make no mistake about it, if there's a recession, there will be bankruptcies. You're already starting to see, retailers going bankrupt in the last year. It's a big problem, but not all companies. That's not going to affect all companies equally. So the smart thing to do would be to analyze the companies that you think will do well over the long term and that you believe in. Work with your financial advisor to come up with a reasonable valuation where basically if it hits this price, I'm going to buy. I know for a fact it could keep going down, but I also know I have confidence that this company is not going to go bankrupt. So over the long term, I'm getting this company at a discount. That's what Warren Buffett does. I think it's great advice. Be more likely to buy in these times. But again, that's for the people who are long-term investors. If you need the money in the short term, you really should talk to your financial advisor because anything can happen in the next 6 months, in a year, and you absolutely don't want to be putting money that you may need in a year at risk, and then in 6 months it's down even more, and you've jeopardized your retirement even more. That would be disastrous.
I think with the policies that are going on right now, I think it will definitely affect a lot of the spending behavior. So people will likely, if the government is trying to keep things domestic, I think people will start buying things that are made in the USA just because it is trying to. It won't be as affected by the tariffs, especially if there's going to be a lot of inflation. People need to make the most out of what they have.
Yeah, that's right. And if people stop buying stuff and they just are, you know, basically clamping down, that's not good for the economy. And this is why you're also starting to see a lot of worries about stagflation, meaning the economy stagnates, it either is flat or it goes down, and yet inflation is eating away at the buying power of people. That's also a very bad
It
situation.
will be interesting to see how companies that are specific to the US, like Walmart, do during this period. And it's pretty obvious that other companies, like such as Temu, are not going to do as well because they relied on so much to selling to the US. And with prices going up, it's going to definitely affect their revenue.
I think that's right, and I think that's by design. The current administration has the view, rightfully or wrongfully, you could agree or disagree, but they certainly have the view that uh, the American consumer in this country has been taken advantage of, meaning that China has disproportionately benefited from this trading relationship, and they're going, very vocally saying that they're going to change that going forward, and that's not going to be good for exporters of Chinese
I
goods.
even read that some companies in China are trying to directly sell, like manufacturers in China are trying to directly sell to consumers here. However, that is high risk because if something happens and you don't have an intermediary, such as an Amazon, for instance, that can stand behind that vendor who is selling to the
Yep.
consumer, there's no recourse in case things don't, they take the money and they don't send the goods.
Yeah, it's a very, very difficult time for many, many companies. If I may, Michelle, I wanted to go back, and I don't think this discussion would be complete if I didn't talk about two rather esoteric options that people do have, but I wouldn't advise them to use. So the way that a lot of wealthy individuals and family offices and institutions hedge against the downside risk is they do engage in either options trading, where they are selling options or they're buying options to essentially profit from the market volatility and the market going down. The other thing that hedge funds do, and this is something that the Lighthaven Fund does, is we're shorting stocks and ETFs. And shorting is a complicated topic. Well, it's not actually that complicated, but it's risky. But we're basically borrowing stock, selling them, and then returning that stock later. So it'd be like if you borrowed a cup of sugar from your neighbor, used the cup of sugar, or sold it today for whatever sugar's worth today. Promise them, hey, I'll give you back the sugar next week or next month. Next month, if the price of sugar drops, you could go back to the supermarket, buy the sugar at a lot cheaper price, return it to your neighbor, and pocket the difference, less some commissions and some transaction fees. So that's essentially all stock short sellers are doing when you hear then the news, and that's what hedge funds are doing. But the reason that's very risky is because that works if the price of sugar in my example goes down. But if the price of sugar goes up, there's theoretically unlimited losses. So this is not something that I think the regular person should do. But if you do want that type of protection, this is precisely the sort of thing that you may want to look into in terms of like maybe investing in a hedge fund where you could outsource that service.
Speaking of hedge funds, I think it's also important to differentiate the different styles of hedge funds, right? There's the Kathy Woods, for instance. There's lots of different kinds, right? There's also Ray Dalio's hedge funds. So do you want to take one of the more controversial ones like Kathy Woods and explain how that differs from Lighthaven?
Yeah, sure, sure. So Kathy Wood does not operate a hedge fund, contrary to popular belief. She operates an actively managed exchange traded fund. So that's just fancy word for it's like a mutual fund, except you could trade it every day. And instead of it being passive, like they just buy, you know, 10 stocks or 500 stocks like the S&P 500 and just let it ride, or it just floats with whatever the market capitalization of the S&P 500 is. She is actively picking stocks, and that's all it is. So you're invested in a fund. It's essentially very similar to a mutual fund. Um, Now, Ray Dalio, his funds are hedge funds. So he runs a firm, or he used to run a firm called Bridgewater. He's retired now, and they've got many, many strategies. One of the, many funds. Some of them are like Lighthaven, long short equity, meaning they are betting on they're on some stocks to go up, and they're betting against other stocks to go down. That's long short. Also, Ray Dalio is very well known for macroeconomics. And so he's got funds that basically make bets on the economy and big macro themes that you could research if you simply go to Wikipedia or AI. You could type in Bridgewater and it'll give you a description of those strategies. But those macro strategies are also, my understanding, I don't personally do that strategy. Those are, have done fairly well in the past. I don't know how they performed this year. But I will say that right now, the funds such as ours that do short stocks in addition to being long stocks, those are doing quite well.
So it's not fair, it's not synonymous to say that hedge funds are actually more risky than, say, an exchange traded fund.
It's hard to generalize. I think the tricky thing is that, I mean, we've all heard do you remember a few years ago, there was GameStop and a bunch of retail investors caused a short squeeze in GameStop, and it actually caused a hedge fund to collapse. So certain hedge funds, again, if they don't manage the risk carefully, if they use leverage, because hedge funds are less regulated than exchange traded funds or mutual funds, they have um, more options. They have more things that they can do. They can potentially be riskier. So you have to do your due diligence, and you just have to ask. The questions would be, what's your strategy? Do you use leverage? Do you use options? How do you manage risk? And those are logical questions you should ask every hedge fund manager.
That sounds good. And if somebody has more interest in learning about Lighthaven, then definitely feel free to reach out to Eric for a detailed explanation about the strategy.
Yeah, that's right. Thank you I'm happy to talk to anybody anytime about to answer your questions, or if you'd like just to talk about what we're doing, or if you want to strategize on questions that you should be asking, your financial advisor or other hedge fund managers or ETF managers that you're thinking of investing in.
That's probably a good place to end our episode for this week. Thank you so much for listening, and I hope it was worth your time. And if you have any suggestions for future topics, please let us know in the comments below.
Thanks very much. Talk to you soon.
The Fiscal Fortress, where wealth meets wisdom.